The true heartbeat of the global economy, the financial oil market, has remained out of reach for most until now. Introducing Onyx Markets, the first platform to bring personal investors into the ecosystem that sets wholesale oil prices around the world. This is where the real economics of energy begin, a market that shapes so much of our everyday lives. Onyx Markets levels the playing field. Access live, tradable numbers from the industry's leading provider of financial oil market data. Whether you're a personal investor or a global corporation, low cost, transparent, and empowering. For the first time ever, you can trade global oil benchmarks like dated Brent, Northwest Europe shipping fuel, and U.S. Gulf Coast propane through spread betting and CFDs. Hedge with precision, trade tax efficiently, and gain unparalleled transparency. Supported by the world's largest liquidity provider in the financial oil markets, Onyx Markets also brings you insights from industry-leading analysts, detailed reporting, and expert-led education to help you navigate this market with confidence. Onyx Markets, the power of the financial oil market now in your hands. Start trading today. Visit onyxmarkets.co.uk.
Watch the Watchers.
Hello, welcome to Oil Insights for a special edition of The Watchers. I'm Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and I'm joined by Jorge Montepeque, Group Head of Benchmarks and Reporting at Onyx. Now, before we start the show, please like and subscribe to the podcast. I invite you to visit Onyx's LinkedIn and YouTube channels for more exciting and interesting content. Now, at the time of this podcast, front-month Brent futures were trading at around $77.50 per barrel. Now, the price action saw a slow grind lower last week following Trump's inauguration as president. This week, we kicked off Monday with a sharp move lower, which sort of dovetailed with the turbulence in equity markets, notably in the tech sector as China deployed cheaper and more performant AI models. The name on everyone's lips yesterday and today is DeepSeek, and that's China's challenger to U.S. dominance in this sector. In this episode, Jorge and I will review the beginning of Trump's presidency and its implications for the price of oil. Now, it's really hard to keep up with the flurry of executive orders that Mr. Trump has signed, and even harder to keep up with his various pronouncements, and we will give that our best try. Now, when we look at the market in terms of positioning from the official commitment of traders data issued by ICE, we could see that money managers expanded their net long exposure to Brent. However, the data only goes back to last Tuesday, a day after President Trump's inauguration. But when we consider the price action that we've seen, and when we look at Onyx's proprietary CTA positioning model, there has been a pairing of length. Arguably, the market preferred to be overhedged relative to the inauguration day rather than be underhedged. So the fact that we are seeing some unwinding of positions that are taking the price of oil lower, is not entirely surprising. The question really now is whether the unwinds have further to go. If we bought the Trump rumor, is there more selling of the Trump fact? That will depend, of course, on how U.S. policy is rolled out and executed and how the market effectively reacts to that execution. Now, Trump's triptych has always been taxes, tariffs, and domestic security. We're going to limit our comments to tariffs and more oil-specific aspects of Donald Trump's new golden age for the U.S. Now, Jorge, obviously last week there was a lot of talk around tariffs, and also a lot of noise. We've seen Donald Trump use tariffs as a threat to Colombia in order to essentially achieve domestic security issues by deporting illegal aliens. We've seen Donald Trump want to put tariffs on Canada and Mexico, maybe as a bargaining stick to renegotiate the USMCA trade agreement. But there's been a lot of talk around tariffs and no execution as of yet, right? And so when we think of everything we've seen, there's been like two sides for me, like the threat and the carrot, the stick and the carrot. And the carrot where Donald Trump has been a little bit nicer to China, possibly Russia, than it has been to other countries. And of course, that raises a number of economic questions that could then, fall out onto oil. What is your take out of this first week?
A lot of bluster,
A lot of bluster.
a lot of bullying, and essentially bad economics. If you think really as a free market economist, you have to open your borders and let products go in and out as market forces dictate. If you prevent the exports or the imports, your economy will be affected adversely.
The consumer ultimately always pays the price.
And in order to get that good, you may misallocate resources internally to make cheap toys rather than to do NVIDIA chips, as in for instance. So in trade, it's always about competitive advantage, and many people don't understand that sometimes it's cheaper and better for your economy to buy something from abroad than making it internally. I don't want my children to become truck drivers to deliver goods or to work in a factory to make cheap toys, for instance, right? I would like them to go into what they can do better. If you take a paternalistic approach to a country, you should let free market forces operate, because then your citizens will do what they're better at.
It seems Donald Trump is really looking at tariffs from two different angles. So obviously, the whole "Make America Great Again," but it's also a source of funding. Yesterday, we understand that he may want to impose 2.5% tariff on pretty much everybody and anything. So whether he's going to get the money to then be able to put in place tax cuts, who knows? But we haven't yet seen him pull the trigger. And that, I think, is kind of interesting, because certainly the multiple aspects of tariffs, whether they're inflationary, which kind of leads the Fed to staying on hold, whether they impact industrial production in other countries, such as China, and therefore prospects of oil demand growth get affected. I mean, at the end of the day, are we any clearer in your view as to what he really wants to do? Or is this, as you were saying, a lot of bluster with a view of eventually reaching a quick settlement with whoever he has a dispute with?
Yeah, it's a bullying tactic. He knows that America cannot produce those things that the Chinese are better at producing. It would be, I'll use the word dumb to do that. So for him,
that's
tariffs,
a technical word, right?
Yeah.
Okay.
Tariffs, and by the way, we are celebrating the change of administration in America.
Yes, we are.
There are some good ideas there. It's not all negative.
No, which is why we're sporting these sweaters.
In fact, we like the can-do attitude of America. The push to lower taxation, the push to more technology. There are a lot of very good things. Tariff is not one of those good things, because it's seen as essentially a revenue raising, as you indicated, and also as a punishment tool. And you could say, who's the U.S. to be the punisher, so to speak? Because this will create a counterforce in the world to move. I have been traveling in China. I have been in Singapore, in the Middle East, in many areas in the last 6 weeks. And you can see the reset taking place. Let's not forget that China's economy is only about 15% dependent on imports to the U.S. They export a lot to the rest of the world. So
15% of the U.S. exports effectively head to the U.S. The rest go elsewhere. So yes. At the end of the day, how much can you compress that 15% and the impact it's going to have? So, I mean, from your point of view, what we're looking at in terms of negative impacts for China, if they keep on with stimulus measures elsewhere in the economy, maybe it's not going to be so bad.
Yeah, because really, how much can you compress that by a third? So that means 5% lost. And that would be a big act to do. It would be damaging for the U.S. economy. So the Chinese have already taken steps to stimulate elsewhere, create the more internal demand, and create bigger exports elsewhere. Yeah. Like to Vietnam and other places is growing. Some of the shipments I was seeing in terms of trains, they have gone up by over 1,000% in a year. I mean, they're just resetting elsewhere. So you cannot push too hard before it starts biting you. And I think he knows that. And this is why he was a lot of bluster, but he hasn't executed anything silly like 60% tariffs, right?
Yeah. So this was always, one of the Damocles swords hanging over the oil market, especially oil demand, when we were thinking about the initial campaign announcements of 60%, as you were mentioning, of tariffs, or up to 60%, because clearly that would have delivered a blow in terms of the Chinese economy. Now, of course, if we put ourselves in that mindset that Donald Trump is a deal maker and he wants to strike a deal fast, then the sort of carrot and stick approach, the stick has been a little bit, bigger when it comes to countries like Canada and Mexico, and I find that interesting because it has regional implications for crude. Because at the end of the day, if the Canadians cannot export their heavier sour barrel, if the Mexicans cannot send their heavier sour barrel to the refiners in the mid-continent or the U.S. Gulf Coast, sour sweet differentials or medium sour to light sweet differentials on the U.S. Gulf. Oh, I was about to say the U.S. Gulf Coast. It's a Gulf of America now, isn't it? Or I don't know if that's been efficient.
In the American eyes, not in the rest of the world.
Well,
so it's bifurcating.
So let's stick to the U.S. Gulf Coast for now. So sweet sour differentials are obviously going to be impacted. However, if we simply get a rejigging of the USMCA trade agreement and Trump gets within that framework what he wants, then the oil flow from Canada or Mexico to the U.S. will remain pretty much unhindered by at least price considerations, right?
So let's try to sum up what is going on here. My position is that Trump is limited by how much he can actually put tariffs by. It's not something that he can go to 60% because he will damage the U.S. economy. He cannot put tariffs on countries that are exporting crude oils that the industry in America needs because it will bite them back, right?
Through the higher product prices. Yeah.
The U.S. Gulf Coast, several refineries have been built to process Venezuelan crude and Canadian crude and Mexican crude. If you prevent that proper flow, then those refineries are going to get harmed. And those oils are going to end up, guess what, in China or some other location like that.
Yeah, so the U.S. doesn't have the ability to substitute out, whatever loss of heavier sour barrels towards its own domestic light sweet crude produced by the shale sector. So no matter how much drill, baby, drill you're going to actually perform, and assuming that the fast cycle supply is shale rather than the conventional that takes several years, well, at the end of the day, you may have more oil at home, but it's not the oil that's needed for your refinery. So,
and not during his administration. The cycles in exploration and production are longer than the one presidency in the US. Yeah. So you can do all you want in year one and you won't see those benefits by year 4. It just doesn't happen that way.
Yeah.
So he's kind of limited, and he's going to find the limits to power, which always happens. But if he continues to use his bluster and lobbying and really bullying countries, he may get away with things that he may get things from the market that he shouldn't. But if people want to bend over, this is their option.
Well, for me, the interesting thing is ultimately resolution around these sanctions. I just said sanctions. It's an interesting slip around these tariffs, sanctions on economic welfare. But so tariffs, because at the end of the day, I mean, the Fed is also meeting this week, and the FOMC meeting is expected to hold interest rates stable, at least the policy rate stable. And if you think about it, if most economists tend to agree that the ultimate impact is going to be inflationary, the impact of these tariffs is going to be inflationary on goods, how could the Fed not take that into account when it formulates policy, right? So we were saying about hurting the U.S. economy. There's also, in my view, the aspects of, well, if you have a higher policy rate, then you're going to get higher yields, and therefore that's going to help a stronger dollar, which ultimately at the end, sort of weighs back on the price of oil. So the Fed, I don't think they can't officially acknowledge in their calculus that they're taking account of some kind of inflationary effect of whatever the tariffs will be, but that has to be in the thinking. So keeping the policy rates up is not necessarily something that is particularly good for the U.S. economy, right?
So we have had the point of view in the last 2 weeks that the markets had hit an inflection point, and we're heading down with the first stop. And we have written this in the officials of 76, 77, and we hit those numbers. If it goes towards 75, which I think it may, then we're looking at 72 as the next stop. There have been a lot of sanctions, a lot of disturbances in shipping, a lot of what I would call freakouts by the Chinese and the Indians who just went crazy and tried to source materials from elsewhere. Over time, everybody finds a workaround or gets tired of being told by the US what to do, right? At some point, you make a decision if it impacts your economy strong enough, and the cost to the economy when oil hit $82 was close to $1 billion a day in extra payments. And we can see that already 500, half of that has gone away, and another half is about ready to go. So market is always changing. We need to discuss what the Chinese are doing as to counter. I saw with interest this deep seek change, right?
Yes, that's a new word on everybody's lips, deep seek. But it's interesting you mentioned deep seek because in the propositions of imposing 2.5% tariffs, you also have other propositions targeting specific sectors of the economy, whether that's metals, pharmaceuticals, semiconductors, and then no doubt, obviously, the Trump's desires to invest heavily in AI infrastructure and build out AI in the U.S. are going to be challenged by this newer model of artificial intelligence. Cheaper, less power, using older chips. I mean, it's going to be certainly an interesting.
I'm not going to look at you. I'm going to look at the viewer in the eye. And let me share with you what has happened on DeepSeek in day 4 or 3, something like that. One, of course, I have played with it, but I don't know anything about programming. But one of my colleagues is already using it to program something on Python. Another person I know in trading is already doing it to produce some models and these things. I have never seen an adoption in 3 days of a new release of a program. It's amazing. And of course,
faster than ChatGPT.
And the stock price of NVIDIA got super slammed, 17% or whatever it was, and many other ancillary stocks. But this morning as well, we are noticing an impact on companies that were supposed to either build more power plants or benefit from the power increase requirements due to AI. So this DeepSeek thing is a powerful thing. Is it really as powerful as it looks on day 3? I don't know. I cannot tell you, but it sort of feels that way.
It's interesting because at the end you have the application, DeepSeek, right? But then you have the model behind it. And so the Chinese have gone at the problem of artificial intelligence from the ground up, rebuilding and finding more efficient ways of doing something and also outperforming in the same time. Now, I think that, all these trade issues, these sectoral fights, etc., generates obviously a lot of uncertainty until we get some kind of realization of what is actually going to be imposed or not imposed. And that leaves the oil market a little bit guessing, in terms of direction. So we said, at the beginning of the show, are we going to sell the Trump-backed, right? Is there more to unravel here in terms of the oil price? And you're already mentioning that, and we'll talk a little bit more about that in our crystal ball moment. But I'd like to pass on now to some Trump announcements that have been more oil market related. And I think now twice he's called on OPEC to reduce the cost of oil, which is obviously not something entirely surprising from Donald Trump, because during his first presidency, he also has called upon OPEC to produce more and bring the price of oil lower. And there's an interesting, I guess, balance that he needs to strike between incentivizing the U.S. Oil industry to produce more, drill more, etc., and bringing down the oil price. So we have this situation where I don't think that this time around OPEC is necessarily very amicable to opening the spigot and letting oil flow just to meet Donald Trump's demand. So what do you think?
Well, Donald Trump is not that complicated as an entity. He wants low oil prices, so gasoline is cheap for the voters, so the Americans feel good. So no one should be surprised that he wants low oil prices, right?
Yeah.
Uh,
The announcement is not a surprise.
Not a surprise at all. Number two, what tools does he have? Where Joe Boning, right, to press the producers. Another tool he has is not to put sanctions. The sanctions were put by Biden, not by Trump, right?
Yeah, the latest raft on the Russian dark fleet, that was all Biden.
So that $10 rise in oil price is on Biden's back, not on Trump's back. And Trump has not put anything heavy on the Iranians yet. And I have met with some Iranian origin people. I had a discussion in the Middle East, and our conclusion is that Iran is throwing some peaceful indications with the Houthis no longer attacking all the ships going through the
So an
Straits.
olive branch of sorts.
Yeah. So it's really that they're doing the right thing, saying we're not ready to fight with you. And Trump is doing the same. He's saying let's talk, let's see what we need to do. So there's no maximum pressure there. So anybody thinking that Trump is going to reduce the supply of crude needs to think again. He's not going to do that. And two, Putin is already saying that he's open to have conversations with Trump. So we could see an infusion there. So the problem for OPEC is, do they want to stand aside and not get some cash by producing more while Iran will increase production and Russia will increase production? Or do they want to partake in the party a little bit early? So that's up to them, right?
That's interesting because next Monday, on the 3rd of February, OPEC Plus has its Joint Ministerial Monitoring Committee. And so while it's not a policy-making or deciding committee, it could certainly be, it does offer advice as to which way the producer group should go. I don't expect to hear any particular references to Donald Trump at the next JMMC. If anything, it's probably hold the course. We have an ordinary meeting in May, and so in May they will reevaluate. And by that time, maybe we'll have more clarity when it comes to tariffs, when it comes to what Trump wants to do with Iran. I mean, the only way I could think of trying to entice Saudi Arabia, for example, to produce more oil is to do what George W. Bush did, is ask Saudi to produce more oil only to stick it into the SPR. And Donald Trump has hinted at buying more oil for the SPR and filling it back up to its capacity. Again, that's just words until
and it's
such
subject
time.
to financing. The U.S. has a huge budget deficit that continues to grow.
So
there is the appearance of this behemoth that is very strong, but actually the foundation is very weak.
Yeah. So at this point for OPEC, I suppose there is not much change from when they met in December to reevaluate their supply policy and push back the return of voluntary cut barrels into the market. I mean, our balance typically tends to show that if we do have stock builds, right, this year in 2025, I mean, they're taking place off a low level of inventories in 2024. So even though we're looking at a big stock build, it's not something that's going to be flipping the curve into contango. If anything, I mean, my expectation is we continue to trade in shallow backwardation, which is good for OPEC. I think the only thing that, relative to President Trump and his calls is basically what kind of rhetoric they're going to find to express the fact that they're reliable suppliers and they want stability in the oil markets, et cetera, et cetera. The usual stuff,
I mean, high level OPEC is in a very, very bad situation. They had room to maneuver, to produce, to talk to the members, but they're in a room in which they increasingly paint the floor and reduce their corner. They're being self-corner, right? If the cut is like painting more of the area and you reduce your maneuverability. So what tools do they have for this coming year? The world economies are not doing superbly well, are they? Europe is flat on its back. And if the US and China fight, then China will slow down further, and America has its own oil. So OPEC, in a way, my advice is give it up and produce and become the lowest cost producer, so you have a seat at the table rather than pretending that the oil price is 80 when in fact it's not, right? It's because you have painted yourself in a corner. And over time, you will lose that position.
I guess that's always the eternal conundrum for OPEC, and whether this time around it's going to be even stronger under a Trump presidency, where, I mean, you highlight the fact that, regain your market share, make up in volume what you can do and what you can achieve in price, right? And right now, as we're saying, the way we're talking about things, and we said this, even well before the elections, we were asking ourselves a question if Donald Trump was bearish for oil prices. And so, it puts OPEC.
He is definitely.
So
we'll not kind of say it slowly. He is bearish for oil prices.
At that juncture, of course, well, we'll see what the JMC recommends, but I'm not expecting much. There's no reason why they would budge on the current policy. Maybe in May, when the ordinary OPEC Plus meeting joins up, there's something different. But, away from Donald Trump, away from OPEC, you and I were both in the UAE, and before that, you spent a lot of time in China. We just wanted to share with you guys some of the, at least the key thoughts. We don't want to, we can't cover everything, but one of the really big aspects of talks that you and I had in Dubai and Abu Dhabi was all around gasoline demand and China, right? And there's obviously here something to be said about the penetration of electric vehicles that is affecting, by design, not necessarily by market economics, but by design, the growth path of Chinese oil demand overall, but of course, Chinese gasoline demand, right? So. Yeah. Tell us a little bit, like when you went to China. Basically, you had this great image you were telling me about. Like you were on the streets of these larger cities, granted, but where we weren't hearing engines with just tires on the road.
Yeah, just tires on the road. I was in a place called Chongqing, which is deep inside of China, 36 million people city, and really in the center of this city, 90% of the cars are EV. All the taxis, all the public transportation is EV. And the cost is really, call it 10% of what it would cost you if you have an ICE engine, right? Which is a repeat of the term. My apologies for that, right? But even in the Middle East, we were in cars while we were visiting our clients that were electrical. And why? Because you buy a car for 2 years and it comes with free electricity for 2 years. So even though gasoline is super cheap in the Middle East, free is cheaper than cheap, isn't it? Right? So they buy the electrical cars. They're very popular in the Middle East. So anybody who's thinking that gasoline is still growing and is advising any OPEC member, any consultant that thinks that gasoline is growing, really needs to get another job. They're so wrong.
Well, certainly in terms of inferences, like at the end of the day, for me, if indeed China by design is pushing EVs pretty hard. Now, of course, it doesn't mean the entire country is on EVs, but in terms of share of new vehicle sales, there is a really big transformation happening. But what concerns me is basically the dynamics of the gasoline market, because at the end of the day, you have all this refining capacity, and sure, some of it may shut down, also by design. But if you're not consuming it domestically, then you're going to have to afford higher product export quotas, and the Chinese will push more gasoline into the international market. Now, if they push more gasoline into the international market, we also have in Nigeria Dangote that is also making its gasoline, whether it goes abroad or stays at home, doesn't matter, because all of this dynamic is going to start weighing on gasoline prices globally, and the ones that are going to be most affected are, of course, European refiners, right?
Europe exports a lot of gasoline or gasoline components, call it that, into the US. US consumes a lot of gasoline, right? So in theory, the two sectors that get hit are America and Europe, but Europe will get hit harder. One of the recurring themes we have with my colleagues is under all scenarios, Europe loses. I see every economic sector and under all scenarios, Europe loses. I mean, it's a terrible thing, really. There needs to be a huge reset here or Europe to have a chance in anything. Otherwise, it's just decay.
Well, keeping with the gasoline story, I mean, this is what is, especially in terms of transport fuels, if we are looking at China's contribution, then it lends itself to the more conservative growth rates that that are being put out there in terms of demand. Now, I was mentioning we'd have our little moment on oil prices. So, as usual, we have our crystal ball moment. So, when we got into the studio, we were trading at 77.50, was it? Thereabouts. We had made a call for lower prices. My personal view is that, at least in the first instance, we returned to the levels that we had towards the end of last year. We had an equilibrium in the low 70s. That would be sort of our first stop, like maybe $72, $73 in the next couple of months. Thereafter, it's hard to say because we don't know what the ultimate tariff picture is going to be looking like and how that's going to be affecting various economies, how that's going to be affecting central bank policy when it comes to rates, especially by the Fed, etc. So how do you view things? Are you also looking at, like me, at having this low 70s come back? But then maybe that's not too controversial.
Okay.
Question is what happens after that, right?
Okay, what do we know? We know that Europe, for all practical purposes, is shrinking. It's indicated, right? We know that Trump is pushing for low oil prices. We know that the large OPEC members don't want to make an enemy out of Trump. Therefore, on the aggregate, and we know that gasoline demand is being challenged globally. So everything is saying bearish to me, negative, right? And yes, we have sanctions that can create these temporary fluffs, but the underlying line is down.
So in terms of direction of travel, obviously markets don't move in straight lines. We're going to have periods where prices go up for one reason or another, and then they may overcorrect. But so basically you're drawing a picture of, well, at least the path of least resistance or the direction of travel is lower. Would you go so far as some Wall Street banks that have famously come out calling an oil price in the 60s by sometime this year?
This baby is falling out of bed and cracking its head.
So I refer you to yesterday's official publication to understand what that means. So check it out on LinkedIn.
Yes, read it. So yes, 60 is in the bag.
Yeah, I mean it's very interesting because with Trump and in the run up to obviously the election and then his inauguration, there's been various views. Some people have been extremely bullish, citing maximum pressure on Iran, a number of factors, and so on. We are definitely of the opinion, as Jorge was saying, that to fulfill on campaign promises and to bring inflation lower, the first target is going to be lower prices at the pump for gasoline. And that, I think, is a overriding concern for Trump. Because if he's going to be imposing tariffs that are inflationary, you need an offset somewhere. And I don't think he could do much about the price of eggs, which are up by some crazy amount again in the U.S. So if anything, if there's one, I suppose, steady rudder in Trump's ship is this need for delivering on inflation through lower energy costs, right?
So let's sum it up and let's close the day. Guys, sell it down. This thing is going down.
So with that concludes our podcast. So thank you everyone for joining us today until our next episode. So don't forget to smash that like button, of course. Subscribe to the podcast and, well, watch the watchers.
And read yesterday's officials. We'll see you.